Greetings viewers, I, Dr. Isha Raval, working in the capacity of Associate Professor at Vivekananda Institute of Professional Studies, Technical Campus, Delhi, welcome you to the series on Security Analysis and Investment Management. In today's session, we will be learning about what exactly is modern portfolio theory. This is a very popular theory which was proposed by Harry Markowitz in the year 1952. But a lot of debate has happened over this theory, that what is the whole sole purpose of having this theory. We all understand that a portfolio, per se, as the word suggests, is a combination of various assets. Obviously, nobody wants to keep all their eggs in just one basket. So the idea is behind creating a portfolio is to diversify the risk of incurring a probable loss, because if we stay invested in just one specific sector, in just one specific investment alternative, we are exposed to huge amount of risk. The risk primarily is unsystematic risk, because that is very much related to a particular industry or a particular business. For example, we have witnessed in the COVID times when we experienced pandemic that a lot of people were incurring huge losses in real estate sector, because at that time the situation was such that everybody was running for their life, they wanted to save their life, and nobody had interest in the real estate. While at the same time the medical sector was doing very good, the pharma sector was doing excellent, the insurance sector was doing wonderful. So had we created a portfolio wherein we have a mix of real estate stocks, a mix of pharma stocks, and few stocks from the maybe the insurance sector, the probability of incurring loss goes down. Why? Because when you are incurring loss in one sector, the profit in the other sector helps us in nullifying this loss. So overall, the investor gets positive returns. So the whole idea behind creating a portfolio is to minimize the risk. So, under modern portfolio theory, it was proposed by Harry Markowitz that why diversification is a very good idea. Why investors should go ahead and invest in these multiple stocks, multiple investment alternatives instead of just having one. So, this theory, which was proposed in the year 1952, actually helps in finding the balance between maximizing one's return and minimizing the risk at the same time. Now, we understand that as a logical, rational investor, we would always want to have the maximum return, and return certainly has to be positive and not negative. So, when we are trying to maximize our return, the argument comes that we need to bear the maximum risk as well. So, how can we expect the maximum return just by staying invested in treasury bills? If you look at the return of treasury bills currently, which is somewhere between 6.9 to say 7%, so that is a bare minimum return, which is actually known as the risk-free rate of return. So a return which you are getting without bearing any additional risk, obviously the return will not be up to your expectations. Why? Because when as an investor you would want to beat at least the inflation rate in the economy. You would certainly want to have your positive alpha. You would like to have an additional return over and above what the market is getting, over and above what the risk-free rate of return in the market is. So this modern portfolio theory actually tries to build up such a portfolio, tries to identify such weights of the various assets in the portfolio wherein your return can be maximized, or at the same time we can focus on creating a portfolio where your risk can be minimized. Actually, this theory strives to diversify the risk while maintaining a given level of expected return. So as an investor, when you start investing, you always have a very clear picture in your mind that yes, this is what I'm aiming to earn. So if I am creating a portfolio of say rupees 2 lakh currently, I would certainly be sure that I would expect a bare minimum return of 20% because I am bearing so much risk. So all those portfolios which provide the maximum return for a given level of risk, or we can create portfolios which provide the minimum risk for a certain level of return. So there are two things which are happening at the same time. One is that we can focus either on maximizing our return where we know that this is the bare minimum risk which we can bear, or at the same time, instead of opting for maximizing return, If I am, say for example, a risk-averse investor, I do not prefer taking risk, or if I have set a benchmark that 10% is the bare minimum risk I can bear for my investments, then I am sure that this is the maximum I can bear. So you set a benchmark of 10% risk and then you try to attain the weightage of your portfolios. How much do you want to invest? So Harry Markowitz's modern portfolio theory help us in creating portfolios which provide the maximum return for a given level of risk, or we can create portfolios providing the minimum risk for a certain level of return. So we can do either return maximization or we can do risk minimization. Now, how do you calculate the performance of a portfolio? If you're investing say 2 lakhs today, how do you judge that 1 year down the line, how much are you making out of it? What is your return or what is your risk? So technically, when we try to calculate a portfolio's performance, it is the result of the performance of its components. Now, what are those components? The first component is the return realized on the portfolio, which is actually a linear combination of the returns of the individual investments. When I say linear combination of the returns of the individual investments, suppose you have invested in 5 different assets. So you divided this 2 lakhs into 5 different assets. So 40,000 in each asset. So now when you're investing 40,000 in these 5 different assets, which makes a total of 2 lakhs today, and you want to calculate the return, so you will see 1 year down the line how much is the return which you've got in stock A, how much you've got in stock B, stock C, stock D, and then stock E. Because you've made equal amount of investment in all the 5 assets, your actual return of the portfolio will be the average return. You can just add the individual return on stock A, then plus 2 on stock B. Similarly, you do a summation of the return of individual stocks and you just divide it by 5. You get the portfolio's return. Now the question arises, if we are calculating the return of a portfolio by just taking the average of all the 5, or we can say the weighted average. Now in this case, because we have equal weights, what about the variance? What about the risk of the portfolio? Can we do that in the same way? Certainly not, because here comes the idea of creating a portfolio. Because when we create a portfolio, we try to identify those assets, those investment alternatives which have negative correlation with each other or which have negative covariance with each other. That means we will prefer having a combination of such stocks wherein they do not move in tandem. At least they are not moving in tandem with the market. So if there's one stock which is rising when the market rises, when the Sensex rises or when the Nifty rises, we need to select another stock that which is not having positive beta with the market. In that case, we will prefer having such a stock which is negatively correlated to stock A. So that is why we are able to reduce the overall risk of the portfolio by creating a combination of such assets which are negatively correlated to each other. So how do we calculate the variance, the risk of the portfolio 1 year down the line? The variance of the portfolio is certainly not a linear combination of the component variances. That means we really cannot just take the weighted average of the variance of all the stocks and say that this is the variance of the portfolio. Because there comes the picture, there comes the role of covariance, the role of correlation. So let us understand what is the formula for calculating portfolio's expected return. As I just stated that the expected return of a portfolio is a weighted average of the expected returns of the components. So if we have 5 stocks, we take the weighted average of all those 5 stocks. So we are technically first of all adding the individual expected return of all the stocks and we multiply it with their weights. As you can see on the screen, the formula for calculating the expected return is visible. Now, portfolio variance. Understanding portfolio variance is the essence of understanding the mathematics of diversification. As I just stated that because the variance is not a linear combination of the individual components. In fact, it is not even just the weighted average of the component variances. Why? Because we have to take into consideration the role of negative correlation. We need to take into consideration the role of covariance between the 2 stocks. So if we have, for example, a 2-security portfolio, the variance of such a portfolio can be calculated as is visible on the screen. As you can see that we are taking into consideration the weight of stock A, we are taking into consideration the weight of stock second, and we are also taking into consideration the correlation coefficient. So the formula for calculating a 2-security portfolio containing stock A and stock B is wherein we have XA square, that is the weight of stock A, the variance of stock A, plus the weight of stock B, the variance of stock B, plus 2 into XA and XB. XA is the weight in stock A, XB is the weight in stock B, the correlation between the two assets multiplied by the standard deviation of A and the standard deviation of B. Let us understand all of this with the help of an example. Assume the following statistics for stock A and stock B. The expected return for stock A is 0.15, while that of B is 0.020. The variance for stock A is 0.080, and then we have the variance for stock B as well. The standard deviation similarly, so we understand that the standard deviation is the under root of the variance. So in this example, we have the standard deviation of stock A, which is 0.224, while that of B is also given to you. The weight, that is, we have invested 40% in stock A while 60% is invested in stock B, and the correlation coefficient here is 0.50. Now the most important role here in this entire example is that of correlation coefficient. That means we have a positive correlation between stock A and stock B. That means when the stock A is rising, stock B is also rising. There is a positive correlation between the two stocks. Now let us try to solve this question. The expected return of this 2-security portfolio, as we have discussed earlier, that we can calculate the expected return by taking the weighted average of the individual return of both these stocks. So in this case, what we do is we multiply the expected return of stock A with its weight plus the weightage in stock B, which is 0.6, 60%, and we multiply it with its expected return. So when we do the calculation, we find out that the expected return, or we can say the portfolio's performance is positive, as we are getting 1.80% as the expected return of this portfolio. Now let us calculate the variance of this 2-security portfolio. So when we apply the same formula as we just discussed, that we need to consider the weight of 1 square multiplied by the variance plus weight of 2 multiplied by the variance plus 2 into weight of 1 into weight of 2 multiplied by the standard deviations, their individual standard deviations, and then the correlation coefficient. So when we place all of these values here, we get that the portfolio variance is 0.0428, which is actually less than the individual variances of stock A and stock B. Now the objective. When Markowitz proposed this MPT, the modern portfolio theory, the idea was to create a minimum variance portfolio. The idea was that as an investor, your risk should be minimized, it should be minimum. So the minimum variance portfolio is the particular combination of securities that will result in the least possible variance. So as an investor, you always want to have the minimum risk. In fact, as an investor, you will always say that why should I take risk? Rather, it should be completely a risk-free portfolio. Now, if you're expecting a portfolio to be completely risk-free, obviously the return will not be up to the mark. So when you want to calculate your minimum risk portfolio or minimum variance portfolio, Markowitz actually proposed a model. It actually proposed a formula. We need to calculate, we need to solve for the minimum variance portfolio, and that actually requires basic calculus. Now this can be done in MS Excel with the help of variance covariance matrix. So if you have 5 stocks, you can do the simple calculation in MS Excel. But if you're trying to do this manually, now solving for 5 is not practically possible because we need MS Excel. So let us try understanding with the help of the same example that if we want to do it manually or with the help of a calculator, how can we create a minimum variance portfolio as proposed by Markowitz. Now, a minimum variance portfolio, for example, for a two security case, we can actually calculate the proportions to be invested in stock A and stock B, because we need to know that when will our risk be minimum, how much should we invest in stock A, or what should be the ideal weight in stock A and what should be in stock B. Because we know that there are just two stocks, so obviously we are first going to identify how much are we investing in, say, stock A, for which the formula is given here. So the weightage in stock A is equal to, you can see the formula as visible there, and once you calculate the weightage to be invested in stock A, the remaining amount, because you know there are just two stocks, so the remaining one, that is 1 minus XA. So for example, if the weightage of XA comes out to be 0.55, so the remaining about, that is when we say 0.55, that is actually 55% of your investment should go in stock A. Now for stock B, it is 1 minus XA. So we know that 100% of it makes your investment. So 100 minus 55. So we can safely say that we must invest 45% in stock B. Now this is just a formula which is given to you. This formula is actually only in case of two security case. That means if I want to find out the investments to be made in stock A, I will simply calculate it by putting the formula as visible on the screen. So portfolio variance minus, we have the standard deviation of A into standard deviation of B into correlation between stock A and stock B. All of this in the numerator, then we divide it with the variance of A plus variance of B minus 2 into standard deviation of A into standard deviation of B and the correlation between A and B. So when we put we apply this formula and we put all those values, we can easily calculate that what ideally should be the weightage of stock A. But as an investor, when you start investing, you certainly do not invest in just one or two or three stocks. You prefer investing in multiple stocks. For that, it is always better that you make use of the MS Excel, because we have Excel add-in and we can actually make use of the minimum covariance metric, and through that we can calculate the weights of all those 4 or 5 or 6 stocks which you have in your portfolio. Now let us try to put the same example which we just saw. So I'm sharing with you the same values here. So we have the values of expected return, we have the values of variance, we have the values of standard deviation, the weights. Now here, because in this case we are yet to calculate the weights, so we will not be taking 40% and 60% at the weights as weights of stock A and B. Instead, we will use the portfolio variance which we have already calculated, and we also have the correlation coefficient with us, which is 0.50. So continuing with the same value, we will go do the calculation for the investment to be made in stock A. So if we look at it, the weights of the minimum variance portfolios in the previous case are, for XA, if you put in all the values here. Now when we are putting the value of variance of stock, the portfolio, we need to put the variance which we have already calculated. So once you put in all these values, we get that we must invest somewhere close to 59.07% in stock A. So that is ideally the best weightage which should be put in stock A, because we are able to minimize our variance by investing 59.07% in stock A. For stock B, as I just explained, that we know that it's stock A and B which makes total of the portfolio. So it is going to be 1 minus XA, or we can simply say 100 minus 59.07%, which comes out to be somewhere close to 40%. So that means ideally it is 60-40 ratio, which is broadly, if we just try to take an approximate value, which is coming out to be the ideal combination of stock A and B with an objective where we are trying to minimize our risk. So here I just said that you are creating a minimum variance portfolio. You are not focusing on the returns right now. Rather, the objective is to create a portfolio wherein the risk is the least. So you're trying to identify the minimum variance portfolio. You're trying to create the minimum variance portfolio with the help of Markowitz's modern portfolio theory. Now, this theory has been talked about a lot, and there are many assumptions that as an investor, you're always rational, there are no taxes, which is actually, all these assumptions have been criticized a lot. Why? Because as an investor, when you're trying to create a portfolio with the minimum risk, you always say that why should I just focus on risk? Instead, I as an investor would like to maximize my return, keeping intact the risk as well. So as an investor, you would always say that you give me maximum returns and I'm not ready to bear any sort of risk. But that is again not possible. So there has been a lot of debate on it, and a lot of models have been developed after this modern portfolio theory was proposed. And this theory primarily focuses on, the major emphasis on is on the correlation, the role of correlation, the role of covariance between the various assets. So if you're investing in, say, 5 different indices belonging to 5 different nations, obviously that all of them, most of the times we have seen that they move in tandem with each other. So if you get positive global cues, we witness that in India the indices rise. But if the global cues are negative, we witness that the stock market opens in red. That means when we are creating a portfolio, most of the times it so happens that the news, the environment has a major impact on it. But the idea here is that you try identifying those stocks which are negatively correlated. You try identifying those stocks, those indices, or those investment alternatives which do not move in the same direction, which preferably have negative beta with the market, because in that case you're able to minimize your risk. So if we look at this diagram which is visible here, we can say on the x-axis we have the portfolio variance, and on the y-axis we have the investment to be made in stock A. As you can see here, that the variance is minimum when we actually invest 59.07% in stock A. So when the weightage is 59.07% in stock A, we are actually minimizing our portfolio variance. We are at a position where the risk of the portfolio is at its minimum level. So if we increase the weightage from 59.07 to say 60% or 70%, you can see in the graph that the variance is increasing. Also, if we reduce the investment in stock A, we reduce the investment in the stock A, in that case, even after reduction, the variance starts to increase. So ideally, it is 59.07% where we get the minimum variance portfolio. So let us just try to identify what is the relationship between correlation and risk reduction. So portfolio risk actually decreases as the correlation coefficient in the returns of the two security goes down. It also decreases. Risk reduction, that is the greatest, that is the maximum, when the securities are perfectly negatively correlated, while if the securities are perfectly positively correlated, certainly there is no risk reduction, the variance of the portfolio will be high. So with this, we summarize today's session. Thank you so much.